Hello and welcome back to another episode of the special broadcast Axis Mutual Fund Masterclass and Investor Education Initiative. I'm Tamanna Inamdar. Now, if you've tuned into our previous episodes, we hope to have given you a basic understanding so far of how mutual funds work and how to get the most out of them. But today, we take it to a whole other level by understanding what will work for you. Now, mutual fund as a category has several kinds of instruments, and it's important to understand which type of mutual fund you should go for and what would be beneficial for you to make the most of your hard-earned money. Helping us do this today is Ashish Gupta, Chief Investment Officer for Axis Mutual Fund. Ashish, great to have you on the show. And thank you so much for speaking with us.
Thanks.
Now, the general idea of people when it comes to mutual funds is that this is a way to put money in the stock markets.
Sure.
General perception.
Sure.
कि हम म्यूचुअल फंड में पैसा डाल रहे हैं यानी हम स्टॉक मार्केट्स में पैसा डाल रहे हैं.
Sure.
But it's much more, isn't it?
Yes. And I think that is the general perception, but there are several categories or types of mutual funds, and there are various needs that mutual funds fulfill, right? The three main types of mutual funds are equity mutual funds, which is investing in the stock markets indirectly. There are debt mutual funds, and then there are hybrid mutual funds. Equity, as you know, as an asset class, is something which is the best hedge against inflation. It is for most Indians, I think, the best way to participate in the India growth story.
When you say the best hedge against inflation,
Sure.
what does that mean?
We want our money to keep pace with inflation or grow faster than inflation. Because if we keep cash as it is today, it loses value over time because prices keep going up. If we invest in financial instruments which return more than inflation, that means the value of our money is actually increasing, at least at the pace of inflation, so we can still have same purchasing power or better purchasing power compared to where we started from. Right. And I think equity mutual funds provide really the best opportunity to do so, because over the long term, capital appreciation on equity mutual fund or equity market is higher than typically the inflation, because you participate in the growth in the economy.
ओके तो इसको एक एग्जाम्पल की तरह से हम समझते हैं. इन्फ्लेशन की रेट फिलहाल 4.5-5% के आसपास है.
Yes.
आपका मतलब है कि टैक्स के बाद
Yes.
मेरा रिटर्न
Yes.
इससे ज्यादा होना चाहिए.
Yes. And अगर हम लास्ट 10 साल 20 साल 25 साल देखें, equity mutual funds have consistently grown asset value much more than inflation on post-tax basis as well. In fact, equity mutual funds are one of the most favorably taxed instrument in the country. For savings, the most tax efficient instrument is actually equity mutual funds today.
So then why should I even look at other categories?
Yes. So equity mutual funds are great for the long term, but there is always volatility in stock markets, right? We believe that over the long term, you will always be better off, but different people have different needs and different terms of investment. Someone wants to invest money for 6 months, someone needs money after 2 years, someone just wants to save for his retirement. And depending on what your needs are, depending on when you need the money, you need to look at different products. Debt mutual funds are one category where your returns are more stable. The value of the fund will not go up and down over time by a meaningful amount. It will consistently give you a return, typically slightly better than what a bank fixed deposit will do.
And is your capital protected like in a bank fixed deposit, since you took that example?
So there is no guarantee, but over the period of time, your capital is typically intact and you keep earning interest. So there are within debt mutual fund some which pay out the dividend, which is equivalent to the interest you get on a bank deposit, some which keeps adding it to the value of your investment, and you get a higher amount at the end of the investment period.
तो Adarsh, why don't you tell us about the debt mutual fund part of it? If equity is so attractive, why should people go for debt? What's the advantage of debt?
Sure. So debt mutual funds try to provide you with more stable and consistent returns. Equity mutual funds provide a return over the longer term, but during short periods of time there can be volatility. उनकी price ऊपर नीचे हो सकती है. Debt mutual funds typically invest in very secure instruments like government bonds, bonds of very high quality AA, AAA companies, and they earn a consistent coupon, a consistent interest rate, which they pass on to you. And this is what makes their return stable over time, and it is a great product for people looking for more certain level of income. So if a person is retired and he wants a monthly income, it is better for him to have an investment in a debt mutual fund and be reasonably certain what is the amount of money he will get in a particular month.
So the younger you are, the more you go towards equity. Is
Yes.
that one way to understand it?
Yeah, I will actually say that across the life cycle, at all stages, you need to have certain allocation to equity, because what we started off by saying that this is the best hedge against inflation, right? So even when you are retired, yes, you want certain amount of money for monthly expenditure, but you need certain money to be in equity so that you are able to keep up with inflation or better your investments than inflation.
Okay. So, simply put, decide what you want the money for, what stage of your life you're at, and what your risk appetite is.
Yes.
And then you can decide which kind of mutual fund works for you. Thank you so much,
Absolutely.
Ashish, for joining us today.
Thank you.